was recording well, but parts of the screen, so it doesn't matter. So let's go. Okay, so money markets are markets for securities maturing within 12 months. Could be 6 months, could be 8, 9, could be 10 days, 1 day, an overnight repurchase agreement is also a money market security transaction, basically. Now, bond markets usually long-term markets. Usually trend. One thing I was trying to say is, money markets do not physically exist like stock markets do. They're all electronic. Dealers deal with the money market. They create the money market. Market for securities do not have to be physically existing today, these days. In the past, back in days, 70s, prior to 70s, where the electronic trading was absent, there was physical presence of certain. Even then, a lot of trade occurred between banks over the phone. So there was little over-the-counter, basically little. However, there was still presence of over-the-counter trading. So much of the physical presence disappeared now from that time. The only one we have is stock markets now, where the physical brokers stay in stock markets physically. But even then, we have NASDAQ, which is electronic market now. Used to be for quotations only, but all markets are becoming more like non-physical markets that do not exist in physically. Okay, derivative securities, for example, not usually traded online. Electronic markets usually. Okay. Instruments that we are looking at today include all this list. Have you covered all of them before? Have you done anything on these? Corporate finance, yes?
I thought you were asking.
Yeah, you've done, yeah?
Oh, yeah.
You've done something there. That helps, yeah? Okay. Now we start with treasury bills now. Treasury bills usually issued by government, federal government in the US. They mature within a year. As a result, they are money market instruments, and the common denominations are 10,000 and as low as 1,000. And these are maturities. So this is standardized. So 52 weeks is the longest maturity for treasury bills. And liquidity is quite high. When we say liquidity of a security, yeah, you can sell it fast. You can sell it quick. The market for treasury bills is liquid, implies there is always demand for them. The reason is, obviously, it's a default-free security. In other words, the default risk is virtually none. I mean, doesn't exist. But recent problems in the US economy and inability of Congress to pass the debt limit, debt ceiling. You know, back in 2012, I think there was Barack Obama was battling with the Republican-led Congress to raise the debt ceiling, and they weren't allowing him out of principle, not because there was an emergency or some other. This is political game. So people started worrying now. Start worrying in the sense that investors feared that US treasury bills are not really risk-free. If they couldn't extend the debt ceiling, they won't be able to pay back existing bills that are maturing soon. The way US government does it, they borrow to pay back. That's what they're doing now. Rather than using GDP, you know, the debt ceiling is usually up to the amount of GDP that you produce, output you produce per year, right? At the moment it's 19 trillion. So that's how much US usually borrows up to. And that's how much they have now in debt as well. The total debt that US government has now is about 19 trillion, if I'm not mistaken. And that's how much output they produce a year as well. So to pay back the debt, usually you need to issue more of treasury bills. And Obama needed authorization to do that from Congress. Yes, go on.
If the interest rate goes up, and the value, the price of T-bills will go down.
Yes.
So this kind of risk is what kind of?
Oh, it's not risk actually. It's just interest rate risk. But notice that default risk is a completely different thing from the risk that you're talking about.
Okay.
Do you know what default risk is?
Default risk means the government cannot pay the interest to you. I
Okay. Yes, interest is part of it anyway. Is not able to pay back
Yes.
as stipulated in the contract, yeah? So at the maturity, let's say within that given period, at the maturity, if parts of the debt is not paid, then effectively US government is in, well, what do you call this? Is bankrupt. Governments usually don't go bankrupt. They default. It's the we use them to say to mean that the companies are bankrupt. They are unable to pay using their assets. Government usually may not kind of what do you call this? There's a special term for it, being defaulting on the obligations. There's a special term. I can't remember it, but anyway, so there's a special term for the governments not being able to pay. Like bankrupt companies, there are bankrupt governments, but there's a special term for it. I forget. So that's default usually, yeah. But there's another term I cannot remember that. So government defaults on its debts basically, is then effectively government is bankrupt. But I don't remember the term that can be used.
I think it's default.
It is certainly default. Yeah, there's another term. I mean, to mention, yes, another term. Default. Yeah. Okay. Right. So interest type. The treasury bills aren't issued at certain fixed interest rates. They are issued at discount. So if a treasury bill shows you a par value of $1,000 at the issue, at the time of issue, they could be sold at $998. So that $2 at the maturity, when you sell it back to the government pays you $1,000. So the difference between this purchase price and sale price is basically the gain. In other words, the interest you earned. So there is no fixed interest, unlike other securities, fixed income securities, where there is fixed add-on interest. Here, with treasury bills, there is no add-on interest. Interest is not accumulated on the principal amount. So treasury bills are sold at discount, and at maturity, the investors receive the par value. Clear? A $1,000 treasury bill can be traded at $990 today, and at maturity, you receive $1,000 back, not $990. So the difference between them is the earnings of the investors for investing in treasury bills. And usually the difference is very small because, default-free. So risk premium is very low, or it doesn't exist. For default-free securities, we do not usually use the term risk premium. Risk premium is applied to securities where there is a risk of default of the issuer. Like stocks have a risk premium, corporate bonds have risk premium on them. The cost of corporate bonds are usually interest rates. These interest rates command a risk premium on them. Okay, and taxation, federal tax rate applies, but state and local tax exempted. So the gains you have as an investor from investing in treasury bills will not be taxed at the state and local rates, but the investors pay federal tax apparently here. Now, any questions on treasury bills? We'll come to interest rate risk when we talk about the valuation of bonds. Yeah? But default risk is a completely different thing. Okay, certificates of deposit, CDs in other words. Now, these are issued by depository institutions that attract deposits from wider investors in the market, money market. And it could take any amount. It could be $1 million or 100,000. And they are also liquid, somehow liquid. However, the liquidity depends on the term, how long the CDs are issued for, because it's not default free. Longer the maturity, it obviously will be more riskier to invest in. As time goes by, issuer could default, could not be able to pay back the original amount. Now, issuers are not state organizations usually. State agencies do not issue these usually. In many cases, these are issued by financial institutions, depository organizations, where if, let's say, a bank issuing mortgages may need short-term funding, then they could issue CDs for mortgage loans or any other loans. And now, first 250,000 investment in CDs are insured by the government. So Federal Deposit Insurance Corporation, FDIC, basically. So as an investor, if you buy CD for this amount, this organization guarantees that in case the issuer defaults, you will get your cash back. But amounts above this limit will not be insured, so you may lose these deposits. I think in the UK it's £85,000, but it looks like it's much higher in the UK. And interest rates are add-on. Well, obviously interest rates change, so we do not know exact rate, but it really varies. And certainly rate of interest will be above Treasury bill rates, Treasury yields in this case, because these are riskier assets. Now, we do not usually look at the taxation in this course, and because we are not doing a tax course, we're interested in investments and basics of this, so we can ignore the taxation line in many cases. Now, commercial papers now. Wait a sec, It is a commercial paper. Sorry. This is commercial paper. So I'll correct this. These are issued by large corporations for short-term funding needs. So think of Tesco needing to pay a farmer, let's say, $1 million. They will issue commercial papers for, let's say, 3 months. But as long as maturity is below 12 months, it is traded in the money markets. They are also issued by financial institutions as well, not only corporations. But they are risky because they are not secured. But obviously, Tesco issuing for short term, large corporation, $1 million is not a big amount to pay back for them, right? Although it's unsecured, large corporations are usually, their debt usually rated at investment grade. So there is still sort of security in this, in investing in this. So the cash you invest in these securities are relatively secure than other securities like stocks and bonds, long-term bonds. Interest type is discount. So again, you buy at a discounted price. The payment comes as the par value. So the par value stated on the paper, commercial paper, is usually paid back. So the difference between the discounted price you paid and then the par value is the earning here. So it covers the earning. And in many cases now, there's a new innovation: asset-backed commercial papers. These are issued by banks. So, for example, a bank trying to issue 10 mortgages for $1 million, let's say $2 million, could issue commercial paper specifically for this purpose of funding these 10 mortgages. As a result, this commercial paper becomes asset-backed commercial paper, because the interest earned on these mortgages will be passed on to the commercial paper investors. So default risk really is related, now depends on the ability of the mortgage borrowers to pay on time all the interest payments. Okay, so this is commercial paper. Now, next we have this unusual money market securities. And interestingly, a lot of securities could be money market securities, and this is a case of where a company. So let me illustrate it this way. It's best illustrated using a drawing board, but I think, well, let me use this quickly. Bank risk acceptance. Have you heard about these terms? International finance, has anyone done international finance? Did you study banking finance? Okay. And you know that they are traded in money markets, yeah? Okay, if I can get this working. Right, so. Any questions on this? Okay, next, euro dollars. Now, this is interesting. Have you heard about euro dollars?
Yeah.
Yeah? So what are they?
US dollars accounts held outside of the US.
Okay, so euro dollars are deposits.
Yeah,
Yeah, US dollar deposits in financial institutions outside the US. So most likely it will be London. Now, euro part has nothing to do with Europe. Before EU was created, euro dollar existed well before it, basically. It goes back to 70s. It's just a name, euro dollar. Not to say that US dollar is just a euro dollar to mention, to note or to make it distinctive that the dollars are held in accounts of US banks, but outside the US. Could also be non-US bank as well. So these are dollar-denominated deposits held at banks outside the US. Now the reason is holding dollars in the US banks will be good. They pay high rates. But there's a requirement from Fed, certain requirements from Fed for attracting deposits and dealing with depositors. So banks usually accept the euro dollars outside the US to avoid these requirements, all the rules and regulations that Fed and Securities and Exchange Commission imposes on the transactions. So that's why they have the term euro dollar, but they aren't really related to anything related to the European markets. Now, they usually pay higher rates than US deposits. Now, euro dollar CDs are the ones we trade in money markets. Certificates of deposits. Euro dollar certificate of deposits. So if I, let's say, deposit $1 million in a HSBC here, it's in dollar account. At some point, I really need cash. But because maturity of this euro dollar, or I could withdraw the cash, for example, in the next 6 months. After 6 months, I won't be able to waiting for this. So I will sell the deposit, or CD in this case, to another willing party, and then I won't receive $1 million. Most likely I'll receive 999 something, so less. Yeah? And in the end, the holder of this deposit will receive a $1 million plus interest payment. So deposits are tradable in this case. Euro dollar deposits are tradable. Is this clear? Is this explanation clear? These are deposits, they are not securities, but they are converted to securities by making them certificate of deposit, creating a certificate which guarantees a payment, certain payment at the end, at maturity. Yeah.
So it's like I'm selling some of my deposit.
Exactly. So you have $1 million in your deposit, but you are not able to withdraw it. So you tell me, can you pay me $990,000 now? I need cash now. But in 6 months, you will receive $1 million from my deposit account. So you transfer the ownership to me, basically. And you are happy with the cash now. So you discounted it, basically. Now, in the end, I may receive interest payments and the original $1 million, yeah? It's a sale of the deposit, basically. Someone's deposit to my... First, it has to be... It won't be the deposit. It becomes a security. It's a CD, certificate of deposit. So you sell me the CD that you hold. It's like a bond, basically, treasury bill. Yeah, you buy it with a discount and receive. It could also be possible that I pay you $1 million now, because in the end I receive $1 million plus interest. So it really depends on the negotiation between me and you, how much you are able to give up or willing to give up in return for this early redemption. Okay, Fed funds now. Now, most of individuals, well, we all have deposits in banks. And these banks, that hold our deposits also hold deposits, have our deposits, also are required to have deposits at Federal Reserve Bank of America. So for every pound I have in HSBC, let's say if it's a US branch, HSBC is required to have 5p in Fed, Federal Reserve Bank, as a capital. Just in case there is a bank run, these can be released to meet the demand for cash. So it is clear. For every pound I have, for every dollar I keep in, let's say, JP Morgan, JP Morgan holds 5 cents in Fed deposits. So these are federal funds as a result. So amount of funds there. Now, if you look at any bank, a large bank, I might say, most of the cash they receive, most of the funding they receive for their operations come from deposits, and they could be 4 trillion. So 5% of 4 trillion is a huge amount, isn't it? That Fed holds. So this cash is not doing anything. It's sitting there at Fed, earning a very low rate, and Fed is requiring it, basically. In crisis times, usually, in times of crisis and credit crunch, Fed requires most banks to hold higher rate of deposits. So from every pound, they might be asked to hold 10% rather than 5% to maintain this reserve requirement. Now, banks usually, at the end of, this is actually maintained on a daily basis. Every day, before closing the day, bank looks at the liabilities, deposits. If they have 4 trillion, they should maintain 5% of 4 trillion at Fed. And if at the Fed they do not have that much money, they have to borrow it from another bank to create that amount, to replenish, so that it meets the requirement of the Fed. So the requirement is on a daily basis that the bank should maintain that Fed funds. Now, if there's a shortfall, in that case, the bank calls another bank, asks, do you have excess reserve? So within the Fed, the cash moves from one account to another account. If someone has a surplus fund, they will lend it to the other bank to replenish overnight. So these are usually sometimes called overnight deposits as well. So the cash shifts within Fed among the accounts of the banks. So cash never goes out usually. So banks that do not meet the requirements of Fed funds rate, they usually borrow from other banks within the Fed, holding the deposits within the Fed. Yes, raise your hand.
Oh, I just wanted to clarify. So the federal funds are like places where banks keep their money.
Yes.
Okay.
There's a Fed fund. It's just Fed fund is a fund amount of money held by banks at Fed. It's a fund basically. It's cash.
So where does the banks keep their actual money?
At different banks.
Oh, okay.
So, for example, when I worked for a bank, we had account at JP Morgan, we had account at HSBC, and they would pay higher rates than Fed. So and we weren't required to hold any cash at central bank back in that country. So, however, in Fed you have to. So banks usually maintain correspondence accounts with other banks, and in different currencies. So for Japanese yen, we had to open a bank account at Mitsubishi Sumitomo Bank in Japan. For dollars in the US, for euros in the EU. So we could trade with them basically. And for all these deposits, they would pay higher rate than Fed funds, obviously. Yeah. Federal funds rate derives its name from the interest rate. Derives its name from this fund arrangements. So Fed funds rate is actually key interest rate. Yes.
I want to ask, is it different from required reserve?
It's the same thing.
The same.
Yeah. For other countries, it's required reserve. Like in the UK, you don't have Fed. You have Bank of England. So it's Bank of England required reserve. In Europe, it's European Central Bank required reserve. But in the US, it's Fed funds. Yeah?
But so it's like the money for the bank keeping the central bank.
Yes. Central bank always asks any bank for every fund of deposit they receive during the day, they have to keep 5% of it in the Fed funds or in central bank.
To keep the liquidity.
Yeah, exactly. So bank in case, you know the bank run. Have you heard about bank run?
The,
Suddenly everyone wants their money back from the bank. You sometimes see long queues in front of a bank because everyone is withdrawing. So these funds are used usually. However, this won't be enough when you have a long queue. So you have to borrow from other banks. Yes.
So it's kind of like Simon previously, if everyone's right now to have like a bank account, went to the bank to get their money, there will only be a certain amount in the actual bank because the banks have like
Lent the money already to some, yeah.
Okay.
Yeah,
Okay, that
because these monies cannot be taken away, taken back from the bank, from the borrowers. Fed will release the cash held in the account to the bank, such that so that the bank can pay these deposits requirements. Yes.
What would happen in case of default of the bank?
Default.
Yeah.
A bank's default. Default is actually when they cannot pay their bonds. What do you mean by bankrupt? You mean?
Yeah, bankrupt.
Okay. When they are bankrupt, they are not able to return the deposits.
So they will basically lose their money.
No, since 2008, there is belief that government steps in, because in 2008, when Lehman Brothers chief executive officer said, "We are at the brink of collapse. We need some trillions of cash to pay back all these demands." There was a requirement to investors required that their cash held at Lehman Brothers be paid back. Lehman Brothers created these mutual funds by attracting funding from different people, and then used the money to trade in derivatives markets, also collateral debt obligations, mortgage-backed securities, all of which was high interest paying, but not secure. And suddenly, housing market collapsed, and there was a bank run towards Lehman Brothers. Big investors, institutional investors, HSBC, RBS held cash at Lehman Brothers funds, and they required that Lehman Brothers liquidate their funds. But there was no market for funds that Lehman Brothers was holding, because these funds were backed by assets. These were mortgages. No one bought them from Lehman Brothers. What happened is that Lehman Brothers said, if we do not receive bailout, we will be bankrupt. And the government said, let it go, because if they do bail them out, the next bank, Citibank, or Citigroup, or JP Morgan would be asking for funds. So they thought, okay, let's not do it. But the next thing is they actually really did default on these obligations, and huge systemic risk. So it spilled over other markets, bond markets, stock markets, and as a result, other banks started suffering from. And then good ones, basically better ones, basically started buying the poor ones in the end. And seeing this guy, UK government started bailing out before Northern Rock would collapse and things like that. So since then, now, because of that action governments had taken at the time, today investors believe that banks will not collapse. They are either will be sold to other better banks if there is a risk of default, or will be bailed out. Bailing out means bank stops trading in stock markets and sells majority of stock to government. So government becomes the shareholder by injecting cash. So this cash is used to pay the obligations. So all the deposits will be paid back. So however, there is only a limit to the amount in paper that can be secured or guaranteed by government. That's £85,000 in the UK. But belief is that the common belief among the investors is that banks will nevertheless be bailed out if that happens. Like we don't have that sort of case here in the UK for the time being, I know Barclays has a good backing from Qatari investors, so they won't. HSBC has Americans, so and then Barclays has, RBS has government backing, Lloyd's has government backing, so it won't happen here. But in Italy and Germany, there's a risk of that happening. But German and Italian governments are not actually willing to bail out. Cyprus usually, Cyprus tried to get some funding from Russia as well, I guess, some time ago. But then Putin was asking for more than what they were, giving. So it's, but I don't know what happened to them then. Did they get any funding from EU? Because they didn't want EU funding.
Yes, I think yes. I think in the end they get some funding from the EU.
EU, okay.
Yeah.
The
But
trouble
they
with
had to depositors with more than 100,000 euros.
so up to 100,000
Yeah.
is secured.
Yeah. But
Okay.
over 100,000.
You lose.
Yeah.
In-
And
in-
that was mostly Russian investors.
These were Russians, yeah. Well, Putin was happy that this happened because all of the Russian money was coming was a result of money laundering.
Yeah.
Well, that's what at least the local news was talking about. Money laundering was widespread, and Russian tycoons, all these oligarchs were holding cash in EU banks, and Putin was happy that these EU banks were collapsing because the money was stolen from the Russian economy at the time, back then. Okay, anyway, any questions on this? So Fed funds rate is the interest rate at which banks charge each other for maintaining Federal Reserve requirements.
How's that a security?
Hmm?
How is that a security? Or is it
Funds are traded between banks.
So just for the banks?
Yeah, it's only banks, not individual investors.
Yeah.
Banks trade with each other these funds, and it doesn't become a security. It's just deposit, overnight deposits. Yeah. LIBOR now is not by the way, I should mention this. I should have mentioned earlier that money markets, what we're doing here is covering the terms, plus in most cases instruments. Yeah, not necessarily just securities, all of them. Yeah. So LIBOR is not a security. I guess you know what it is. LIBOR? Haven't heard about this? Okay. Corporate finance may have covered it, but if not, then that's fine. London Interbank Offer Rate, that's a rate of interest at which banks trade with each other. Investment banks, commercial banks trade with each other. Now, LIBOR rates apply to loans banks lend to each other. Now, every morning, an organization, British Bankers Association, calls banks in London and asks at what interest rate you are willing to lend to another bank. They will quote their interest rates, and the list of bank offer rates are then averaged out to get the LIBOR. In many cases, there will be extremes, very small rates and very high rates. They are cut away. So they are basically, we take the 90s percentile. What do you call this? Middle 90%. So 5% of banks at the bottom rates and low at the top rates will be cut away. Basically, will not be considered to work out the average, basically, because they will skew the rates. So LIBOR is an offer rate, the cash offer rate. Now, this is a very serious rate or a serious instrument in pricing loans outside the UK. A lot of mortgages issued in dollars in Asia, in Russia, in Japan are based on LIBOR. So if you apply for mortgage, the mortgage could have an interest rate, LIBOR, that's equal to LIBOR plus 2%. So since LIBOR changes every day, your mortgage rate changes every day. So you have heard about floating rates, yeah? Rates are floating. In other words, you pay LIBOR rate plus 2%. If LIBOR rate is 5%, your total payment will be 7%. Interest rate will be 7% on your mortgage. If LIBOR rate is 3%, then your interest payment is 2 plus 3, so 5%. So LIBOR rate is actually a benchmark for many of the other rates. Okay. And it also works for pricing the derivatives, which we will learn later. These are usually large banks trading with each other. So HSBC wants $1 billion, they will call up Barclays at the library, they lend each other overnight, for example, yeah? Or the other way around. But this is a reference rate for many smaller organizations, a lot. Recently in 2014, I think, it came to light that LIBOR traders, brokers, at Barclays and RBS, I think HSBC as well, they were colluding. These were supposed to be independent offer rates, but they were artificially holding these rates at high rates, at high levels, artificially. So they were supposed to be independent. Each bank should, based on their assessment of the market and other banks' creditworthiness, should offer the rates. But they were colluding through hidden networks that general public or governments won't notice, won't detect. And I think some whistleblower decided whoever was fired or sacked from a bank basically blew the whistle, and then it came to light that major banks were colluding. And as a result, a lot of derivatives prices and many loan borrowers basically started suing these banks because they are paying high interest rates. At the time of the issuing of these bonds and loans, the LIBOR was high. So the borrowers started suing these companies, the HSBC and others, for huge millions of pounds. And government is imposing billions of pounds on them as fines for collusion. So LIBOR is an important reference rate in practice. Now, repurchase. Have you heard about repurchases? Repos. I can give you an example which sums up this slide basically. Repurchase is an agreement between two parties. Usually it's between an individual investor and a dealer. Or a broker, I should say, broker. So we could come together and then I could say, I need cash. It's a very simple explanation. I need cash, $1 million. And I have $1 million worth of treasury bills. I could sell these treasury bills and have my $1 million, right? But I want to hold them until maturity. So I will look for someone who is happy to lend me $1 million and hold my treasury bills as security. But after a week, I would like my securities back. I'll pay back your $1 million and plus interest. So this is a repo agreement, repurchase agreement. Clear? Transaction.
Do they have to?
Yeah, it's a repurchase agreement, yeah. They have to. So I'm borrowing from you. In return, you're holding my treasury bills as collateral. In case in a week's time, I won't return your cash, you will sell the treasury bills at the price, whatever price it is at the time. You may not get my $1 million as well, your $1 million, because treasury bill rate price may go down and you may lose. So it's a risk as well. But usually what happens is that treasury bills may be £1 million worth now in the market. I may get 950 because of risk of price decline. Yeah. For $1 million treasury bills, I may get 950 from you. And then if I'm not able to pay back, then obviously you can sell them at the price of treasury bill rate. Yeah. So that's the repo. Reverse repo is the opposite. You look for lending cash to someone who is able to provide the treasury bills as collateral. So as a broker, you have some cash, but you want a repo agreement with someone who is able to provide you the collateral. So you're lending in this case. Now brokers calls. Now individuals, has anyone traded before? Or you traded? Do you trade on margin?
Yes, I do.
So you could explain us what margin is.
margin is pretty much you borrow money from
Broker.
your broker account and you're paying interest on it, and it's basically a lot of short-term trades.
Okay. So what interest do you pay? What is the amount usually on average? What did you
I
pay?
think I pay about 8.5% a year, but I'm
8
in and out within like 2 or 3 days.
Okay. Usually good thing that you're trading it. 8% is a bit too high, but probably it's what the going rate now. But usually the rate is usually more or less the same as treasury bill rates. However, depending on the risk factors and depending on the brokerage company, there could be a brokerage company, small brokerage company that charges a lot. If you're trading on margin, let's say you want to invest in securities $10,000 and buy $10,000 worth of shares, for example. Now, however, you do not have enough cash for it. You only have 5,000. You could find a broker who is willing to lend you 5,000. So you put your 5,000 in, they lend you 5,000 extra. So you spend your 10,000 on buying the securities shares. So this is a margin trading. You're borrowing from your broker the half of it. And the margin requirement is 50%, for example. So you have to contribute 50% of the investment yourself. Other 50% comes from the broker. You put together this 10,000 and then invest in securities. Now, where do this broker get the cash? So the broker himself is not a bank. Is a broker. Is a financial institution. Could be myself as well. I won't have the huge bank behind me. So to lend you, you are my client. I'll borrow from a bank as well. I'll borrow at a rate just above treasury bill and then lend you. And he gets at 8% apparently, but treasury bill rates are quite low. So it's annual, isn't it? So you pay annually?
I only yes and no.
Okay. Depends on
I'm
how.
in and out so fast. I don't know for you.
Okay, so average works out like 8% then, annualized. Okay, that's a bit quite high now. But in textbooks, usually you are told that it's a quite low rate. However, it depends really on the brokerage company. So you raised your hand. Was it you or you? Sorry.
Oh, I did. Yeah. So basically, this is just like a borrower.
Yeah. Borrowing and lending, kind of thing. Yeah.
So then, do you have to pay like all of these people?
No, you pay back to your broker. Broker pays back. And then the rate is determined in the money markets usually.
So don't they have like different rates that they pay?
They do have their own margins at each case. So bank determines the lending rate to the broker based on the treasury bill rate, and treasury bill rates are usually yields, money market determine it, and then the broker then determines the interest rate that he wants to charge this gentleman based on his credit worthiness and bank account, and he probably supplies financial information to them, and then so in the end, basically, behind everything is the treasury bill rate, so money market rate, and
They can finish.
okay. Then the borrowing that the broker makes from the bank is usually callable at any time. So if broker is not able to fund that borrowing to pay back, we'll have to ask this gentleman to liquidate his position and then pay back the loan. So it's a bit of detail in there, but we are not going into that detail because it's not practical trading. Yes, she was first. Sorry.
Oh no. Oh, one more thing is how long is this? Like a time period that this goes on?
It really depends on negotiation between. And he says he's quick in and out. So that means so long as as soon as you close your position, as soon as he trades every security, he's paying back the cash. That means broker pays back to the bank. If he's holding it for a year, then broker has to wait a year. Otherwise, he will be asked to liquidate his position and pay back all the money to the broker, and broker pays back to the bank. Yes. Your question?
So the brokers when the brokers lend the
Broker? Yeah, the
to
trader.
the consumer.
Yeah.
And then what is, I mean, is it means when the funds goes down to one level, it will call the lender, but call the borrower to fill in the money?
Yeah, that's when we come to margin trading next week. I'll explain that. Yeah, not now. This is about introduction to that.
Okay.
Margin account functioning is for next week.
I searched it before on the internet. It's like this kind of.
Yeah, if the value of your equity is lower than the margin requirement, you have to fill up.
Yes.
Yeah, your own money, using your own money. Yes.
And to this kind of action, the broker will always need a trader of the bond. He can do it by himself.
A broker, no, it's based on request from the trader. Brokers are usually not the traders. They are middlemen between two institutions or two individuals.
So the broker can say, yeah, my client wants
Exactly,
this kind of this,
exactly.
and this kind. So you have to trade this, and the trader, what is the job of the trader?
Trader receives cash from the broker to finance the purchase of the securities.
He has to be advised a little bit.
The broker obviously advises the trader, which stocks to buy and how much margin, at what margin rate they could be providing the cash. Basically, you get a broker. If you are interested in investing in shares, contact a broker. They will guide you all through the process by advising which stocks are doing well now. But they obviously charge commission for this, so it doesn't come there's no free lunch basically. Every single phone call you make probably chargeable, so you have to be able to pay all these commissions. So you need to invest in such security that pay you high rates to cover all this commission cash. And probably you can speak to him now, who will be able to give you more detailed information. But certainly, yeah, brokers are usually advisors to the traders, but at the same time, they are just working for themselves. They charge a commission. Yeah. Now, money market credit crisis, for example, started with the money market downfall. It's an important market, very, very important for short-term funding. By the way, it's what, 1936. Should we have a break, or do you want me to continue? No break? So you want? I didn't get no break, yeah? Okay, so we could leave a bit earlier then, rather than having the 10-minute break. So, the credit crisis in 2008 involved a lot of markets, different markets. One of them was these money markets. Now, Lehman Brothers traded money market securities. Basically, they issued a lot of them. They issued a lot of them to buy mortgage-backed securities. When there was now I call this bank run by investors. So when investors realized that the housing bubble burst, they started asking these money market securities that they purchased to be returned, basically, the cash to be returned, in the sense that they wanted to trade their positions. That was originated by Lehman Brothers. But Lehman Brothers wasn't able to liquidate their own position, wasn't able to pay back all the commercial papers they issued, certificates of deposits they issued, all other money market securities they issued. So they were funding long-term investments using short-term borrowing. Notice that they are not matching the maturities. So to buy a mortgage-backed securities are long-term investments, goes into 25 years. Yeah, mortgages are paid over 25 years. So these these securities are backed by these mortgages. So it's a long-term investment. But Lehman Brothers were borrowing in money markets to finance the purchase of the mortgage-backed securities. So you see, with the collapse of Lehman Brothers, there was a collapse of money market activity as well. So they trust in money market securities declined. So they weren't as secure anymore as they used to be. Is it clear? So it is a long story how the money markets are related to the crisis of 2008. Yeah, it all depended on the Lehman Brothers. Just saying that we are not able to meet all the obligations in the short that we incurred in the past. So the short-term borrowings were not paid back because all the mortgage-backed securities they had were long-term, and they weren't able to trade them as well because market for mortgage-backed securities were dead by then. So not being able to liquidate their mortgage-backed securities, they were unable to pay back the commercial papers, CDs they issued, and other papers they issued. And the funds that they traded in, they created and invested in financial money markets were also illiquid. So their values declined sharply. Now, there was this money market, run on money markets by investors. Now, remember, money markets are for investors, high-value investors, with fundings no less than 100,000. A simple transaction in money markets is about $1 million. Single transaction, smallest single transaction. So money markets is for very big investors. So these investors made a run to the money markets, and yeah, Lehman Brothers eventually wasn't able to maintain its position. Yes.
Can we have a break?
You want to have a break? It's up to you. 10 minutes break? Yeah, he's sleeping.
Because we cannot concentrate on all the for a long time.
I've been awake since 6 o'clock in the morning. So
Oh yeah, okay. Yeah, we'll have a 10-minute break then. We'll see how we are about 30% into covering all this with that I planned for today. So we still have time, don't worry then. We'll try to finish in time. So just to recap, going back to this money markets and the Lehman Brothers. Basically, Lehman Brothers had a mismatch in its maturities. Basically, maturities of lending with maturities of borrowing. You know that if you want to lend long term, really it's better to borrow long term. So match the maturities. Rather, Lehman Brothers invested in long-term assets, borrowing short-term. For instance, this is a case of mutual funds. Basically, I should relate it to the mutual funds rather than telling you the other extra details. Now, money market mutual funds are these funds that are created by large, but sometimes small investment institutions that attracts cash from institutional investors, individuals, and pulls this cash and invests in money market securities like commercial papers, T-bills, CDs, most likely in commercial papers with high rates of return. Now, these mutual funds, however, those that invested in Lehman Brothers commercial papers were not able to get their cash back. They weren't able to sell the commercial papers they invested. So collapse of Lehman Brothers led to the collapse of this collapse in confidence in money market funds. As a result, a lot of investors created this run-on money markets with mutual funds as well. So that's how the crisis kind of spilled over into different markets. This created weak confidence in stock markets as well, bond markets as well. So there was a systemic risk, the spillover of this risk into different markets. Now, until 2008, the only fund that broke the buck, that when we say broke the buck, is when the value of the fund goes below below $1. Minimum net value of the fund should be $1 to stay afloat, to be open. But it had to be bankrupted, or it had to be closed if the value of the fund is below. So all the cash you put in the bank is in the fund is invested in securities, and using this security values, the value of the fund is calculated every day. At the end of the day, the value of the fund shouldn't be below 1 per share. Value per share shouldn't be below 1. As soon as it goes below 1, the fund is bankrupt. It's broke, basically. So that happened with a lot of funds in 2008 when they were unable to trade commercial papers issued by Lehman Brothers. And these commercial papers were actually invested in long-term assets, and these were mortgage-backed securities mostly. Okay, but eventually, realizing there was a wider collapse, U.S. government tried to insure funds, and I don't know the specific details of how much of the funds were insured. Most likely, after the collapse, it was 100% insured, and not guaranteed. Guaranteed doesn't mean that they will pay you all the cash. Guarantee means when government guarantees, it wants confidence back to the markets, to get the confidence back to the markets. So with the guarantee, people start trading these securities rather than liquidating them. Now, money markets, so far we've been talking about, security instruments we've been talking about, have maintained or commanded low risk because of short-term nature, large banks and corporations trading, issuing shares and issuing securities, but they are not risk-free. So we can see this in this graph here. This is the difference between the treasury bills and CDs. And notice that the difference between treasury bill rate, I should say, yield, annualized rate of return for an investor, minus the interest rate on certificate of deposit. So interest rate on certificate of deposit minus treasury bill rate gives us this line, blue line. This is a spread between the rate of treasury rate on CDs and treasury bills. Now, during the crisis period, CD dealers required risk premiums, huge risk premiums. So OPEC crisis, OPEC second crisis. This is the Penn State. I don't remember, the bank collapsed. Then there is stock market collapse, 80s. Then we have long-term capital market bank collapsed. So, and then the financial crisis. Otherwise, notice that the risk premium required for CDs is quite low, very low. At some point, very close to zero. That means during these periods, investors saw CDs as risk-free, at a similar level as the treasury bills, basically. They equated it to a default-free security, especially in this period. Notice this is the period from this period here, from 2002 and 2004. This is the period of credit market expanding. Credit was available to individuals in large amounts, and the confidence in markets was growing. And everyone thought, well, we will continue doing this. We will continue seeing this situation, like especially in the housing market. Everyone thought house prices will carry on growing. It didn't rise as we expected. Come 2006, where is this? Come 2006, can you see? No, my cursor is not moving basically. Come 2006, there's a large expectation. So there's an expectation of crisis. The symptoms of crisis were earlier. So this kind of a spread is also useful here to see like market sentiment and market the situation in the market, overall situation in the market. So we could see the rise in the risk premium over time, and then jump with the 2007 collapse of Lehman Brothers. So during the crisis, there's a huge requirement for risk premium over T-bills. Now, risk premium, by definition, is usually difference between risk-free asset and the difference between the rate of return on an asset and the risk-free asset rate. So in this case, it's the difference between interest rate paid on CDs and treasury bill yield rates. Yeah. So if the risk premiums increase, that is a symptom of crisis that we could see ahead. We could expect a crisis ahead, basically. Like this case here. You see, we already had the symptoms back in 2004, and coming to 2006, it was visible that market was expecting a collapse. That's why the investors required high rates from CDs, issuers, yeah, relative to treasury bills. But governments didn't act properly on that information. So this was a signal, but governments kept pumping money into the market, especially in the US. And now, you see, back to the confidence was regained into the 2010, later 2010, because government's involvement in the markets. They guaranteed that the funds will be secure if you invest. So they didn't really want to give the cash to the investors. They guaranteed. That implies when you see the guarantee, you go and trade. Right? That's what they wanted. And they actually managed to get the spread come down close to zero. And there are a few cases here when the US had troubles with lifting the debt ceiling, I think, here, with Obama trying to increase the government debt to borrow more so that they can finance future projects and pay the interest payments. Okay, now that's it with money markets. Biggest part of it, basically. It basically takes up 40% of the whole class today. Now, capital markets. Now, there are two types of capital markets. One is debt market, so market for bonds, long-term bonds, and one is for stock markets. What's your name, sorry?
Jack.
Say it.
Jack Reese.
Jack Reese, yeah? Okay, thank you. Jack. Should keep that. I do that tendency. Okay, so we look at fixed income securities first. These are bonds. Fixed income securities in the sense that they pay you fixed stream of interest, coupon payments usually, fixed amount of cash. So unlike the shares where there is no fixed income, dividends are not fixed. They either increase over time or decline over time as well. They usually generally increase, so there's a different thing. Different types of them, different types of securities shares pay different rates. Okay, now we start with government issues. Now, US government, other than treasury bill, they issue bonds and notes. And they are different from T-bills, obviously. They are long-term. And they come in different denominations. They also, the interest type is different. Now, in the next slide, I'll describe this in more details. Now, specific, interesting type of treasury securities is the treasury inflation protected securities. Now, once you invest in these securities, government adjusts the principal value to the rate of inflation. So, if you invested £1,000 on treasury bond, you will receive £1,000 back in about 10 years' time. Yeah, it's a long-term investment. But with this TIPS investment, if you invested £1,000 in these TIPS, at the maturity they pay you £1,000 plus adjustment for inflation. So inflation rate during this time was 10%, they add 10% on top of your bond. So you get a real earning here. So your investment is adjusted for decline in value because of inflation, right? So government adjusts this original principal amount, not the interest payment. Now, bonds and notes. Treasury notes are usually issued for up to 10 years, while treasury bonds are issued between 10 and 30, even more in some cases. But it's 30 years generally. And they could come denominations as low as $1,000 with different increments. So you could, but usually the increments of $100. But what happens is that the denominations do not become a major issue because the investments usually made in these securities are in billions. hundreds of millions in minimum in some cases. So this is a large amount of transactions. It would make sense to discuss this if we had a paper-based bonds like in 18th and 19th century when there was no electronic trading. The government had to write the face value on the bonds, $100 each one, and sell them at this rate, at these prices per certificate. But now, well, denominations do not play an important role now. This is all electronic now. And both of these securities pay semi-annual interest payments. We call them coupon payments. Now there's another history. There's a history of why it's called coupon payments, but I don't go into details. But if you are interested, have a look. But coupon payment is just basically the amount of cash you receive every year, twice a year, in return for the investment. So coupon rate is the interest rate you receive in return for investing in treasury bonds and notes. Now this is a typical quotation from a Wall Street Journal online. If you open Wall Street Journal and any financial newspapers, even Evening Standard has a section where they quote, I think they don't have it, so they stopped doing this now. Financial Times will have them, the quotations. Now, the first column here shows the maturity. So this highlighted one will mature in 15th of May, 2017. Coupon rate is 4.5%. So on the par value, every year you will receive 4.5%. So the par value could be $1,000, for example. 4.5% means 45 pounds a year. So, however, the coupon payment is made every 6 months. So you receive £22.50 every 6 months. So this is annual coupon payment. Now, bid and ask are the prices you either receive or pay. Do you know what the difference between the bid and ask prices? Yeah, go on.
The bid is how much you're asking for, and the ask is how much someone's willing to pay for.
Yeah. So bid is how much you will receive when you sell your securities. Ask is how much you have to pay when you buy securities. So if you want to buy a treasury bond, for example, this is how much you pay per unit of it. Now, when they are quoted in percentages, not in. So, for example, this quotation implies basically 109.35% of face value. So this is a market price, by the way, not the original. So as a bond with a face value of $1,000 can be now bought for 1,093 pounds, for example, or dollars, if I am talking about dollars, yeah? So this is a percent of face value. The price is quoted in percentages. So 109.35 basically implies to buy a bond with a par value of $1,000, you pay $1,093. So bond is trading at premium. And sometimes bonds are traded at discount as well. Bond prices go down because of interest rates increasing, yeah? Then this we call bonds are trading at discount. So this could be 99.5 something else. Then you pay $995 for $1,000 denominated bond. Now this is a change in the price of ask price change. So this increased since last time, so since yesterday. So that's that. Then yield to maturity is the annualized rate of return for an investor who would purchase this bond. Yield to maturity is the rate of interest that an individual will receive. Notice that there is a coupon rate and there is also yield to maturity. There are two different rates. And when we do a bond valuation, I'll give you more details and we'll do exercise. Maybe next week we will do an exercise on this. I'll bring it forward so that it will be in your midterm as well, and you will be able to deal with bond calculations later in more details. Okay, that's the listing of treasury issues. Now, in the bond market, agencies also issue their own bonds. These are federal government agencies. Now, in the US, there are two agencies. Fannie Mae, have you heard about them? How do you read them? How do you pronounce them? I usually have a difficulty in pronouncing them. These are agencies, government agencies, that facilitate transactions in the housing market. In other words, provide mortgages, funds for housing market. They are created with the purpose of helping the housing market. And they also issue bonds to finance this. Now, in 2008, towards 2008, by the way, in 2008, these federal organizations, federal agencies, defaulted. In other words, they up to 2007 and 8, they were buying mortgage-backed securities to facilitate the transactions in the housing market. Because if they buy from private issues will have funds to issue more mortgage. You see the point here? Why they are doing this? They were encouraged by the government to invest in mortgage-backed securities issued by individual banks. Remember, individual banks need funds to issue mortgages. One way is to sell the assets to others so that they have more cash to advance more mortgages. And Fannie Mae and other federal agencies were investing in these mortgage securities. In the end, they had huge amount of toxic assets. These were toxic assets. They were underperforming mortgage-backed securities because the housing market defaulted completely. Collapsed completely in 2008. And buying their bonds became so risky that they had to basically, they weren't able to raise funds from private investors. Well, in 2008 it wasn't possible. So government stepped in and guaranteed. If you invested in their bonds, you will be paid back basically. So these are agency bonds. Now, there are also bonds from municipalities. Municipal bonds, munis. Now, they are issued by state and local governments for two purposes, or maybe three. They could be a general obligation bonds to finance infrastructure. There is no collateral because government organization is issuing them, local government. They have taxing power, so the faith, well, they had full faith. Investors would have to have full faith in the ability of the government to tax and collect enough tax to pay back the bonds. So collateral was implicitly the amount of tax collected by this government, or local government organizations. Now, another type of bond are revenue bonds. These were issued by, again, local organizations, municipalities, to finance hospitals and other state-backed organizations that provide individuals or people with certain services. Then there is industrial development bond. Again, they are issued by municipal local governments. But this time, the bonds, the proceeds from bond issue are for financing private sector. For example, guys. For example, Elon Musk might convince Donald Trump that his organization needs to be supported by government through municipal bond issue, maybe industrial development bond issue. Elon Musk might go. Where is he now building this large battery factory? Which state is it in? You aren't watching the news? Elon Musk is actually revolutionizing this car battery technology. Basically, he wants to build largest ever built battery factory in the US state. I don't remember which one.
I know Tesla is
Where is it? Yeah.
California, so-
California. Possibly in California, yeah. So if that's the case, he's going to create large number of jobs, right? So he could convince Donald Trump to get help with funding, and Donald Trump might order the agency, local municipals, to have industrial development bonds, so to develop the industry, factory industry, the battery industry, right? or the electronics industry, right? So they are issued by munis, however, rather than by Elon Musk's Tesla company. Yeah. So it's just the local government helping the industry development. Or car industry in the US is dead now. Most likely it's going to be revolutionized again later by Donald Trump, as he promised to do this. Hopefully he lives up to his words. And
He's focusing on Tesla.
huh?
I think he's focusing on Tesla.
He is, yeah, but he's also scaring the others not to leave the country. Like Ford, last time wanted to leave and open a factory in Mexico. They decided not to. Now they might negotiate with Donald Trump, since you aren't allowing us to go and produce at low prices, rather than putting up the prices in the US. We would like to have some funding. So this would be used industrial development. So auto manufacturing industry could be revolutionized again, reinaugurated. In other words, this could be used. These bonds could be used because government is guaranteeing the payment. There will be a huge amount of cash coming in, rather than Ford issuing to develop a factory in the US, a bond. Ford issues a bond that wants to develop a factory in the US. Who do you think buys these bonds? If they say it's in Mexico, there could be an interest. But if they say it's in US, it will be a very hard thing to do. First thing is, in the US, labor costs, huge. They could pay a Mexican worker $1,000 every 6 months. But in the US, you have to pay them $2,000 a month for a factory worker, right?
No, it depends.
No, factory workers, come on, car manufacturing, don't they get much?
Yeah.
They get a lot.
Federal and state limits.
$2,000 a month.
Federal and state limits will be.
It certainly be different, obviously. But I think I'm exaggerating the rates that Mexicans get. But certainly the
But the thing is,
labor rate per hour is very low. You're
the
going.
thing is that the jobs that car manufacturers actually make is very low because
Is it?
because it's almost fully automated. You just need to-
Oh no, I understand this. It's just when you have a large factory, you certainly have thousands of workers working there, even if they're automated. The quality check, the painting, and all these are always automated, but you have to do a lot of work behind them. Prepare these robots, and you need high-skilled workers that work with robots as well, and also cleaners, the catering staff. Huge amount of industrial development leads to huge amount of workers coming in. So average pay, let's say $2,000.
Yeah.
Yeah, let's say, even if they don't get it.
Mexico, if you need specialists, you're not going to get them from Mexico. You're going to get them from Europe, from the US.
Actually, Mexican government is actually creating this auto industry specialist schools or training camps. Apparently, long time ago, they already have their own. Maybe 1 or 2 trainers come there from the US, but then local ones do not demand as much as the US ones, right? So, assuming this US car manufactured in the US will not be as marketable as the one manufactured in the UK. Sorry, in Mexico, because Mexican will cost less than the car made in the UK, US, right? So the competitiveness is just in terms of price competition is very low in the US. Given this, less likely that the Ford is able to issue bonds and able to raise enough funds. But when government guarantees it, it is more likely that they do, because government is backing. So in case Ford cannot, the government will be paying, right? Clear? So industrial development bonds. So certain industrial development bonds are issued by municipalities, local municipalities like California, certain areas. You raised your hand.
I think also said there's minimum wage, like the rate that you have to, like labor rates or how much you make per hour is like different in the US than like Mexico.
Yeah.
So it's gonna be like higher pay workers in the US versus like other countries. So like different.
Yeah, the cost of manufacturing in Mexico is much lower.
Yeah.
For that reason, I think GM is there.
Mm-hmm.
But then Ford wanted as well, but it was scared by Donald Trump. Basically, they said we won't import them if you open.
So
Yeah, he told Ford. Yeah, he actually.
They moved to Mexico.
Yeah. Ford was trying to open a plant there, a new plant. But Donald Trump in last month said, I think he was condemning GM, but implicitly was referring to Ford. Then Ford obviously cancelled that
He
project.
tweeted one tweet and then their shares dropped. I don't know how many percent.
Huge one, yeah. It was a tweet about GM, but it just was about Ford, and they coincided. And then obviously now Ford will negotiate with the administration and will end up probably having some sort of help from government. Building the factory alone will cost huge amount compared to Mexican factory. So imagine this now. So they need a lot of funding. And then recouping all this funding from sales of car is going to take long. Breaking even is going to take long. So there's a lot of issue there. And taxing, for example, they might negotiate with Donald Trump and then reduce the taxes.
Lower taxes.
Hmm?
He's gonna lower taxes. That's what it's called.
I mean, they will probably get tax-free.
If they stay,
Yeah, he
They
would
stay.
make because his whole platform is to create jobs. So if he wanted to afford and everyone to stay, he needs to give them tax.
Yeah, corporation taxes, for example, if
For the
it's
next 3 years or until they break even.
yeah, obviously it's an individual negotiation, but creating tax-free or low-tax environment implies a lot of companies would like to close their factories in other countries and open them in the US, because what you want as an organization, as a corporation, is that you want to maximize the profits so that the rate of dividends increase over time.
And by doing that, you want to decrease costs. And the US,
Yeah.
it's very expensive.
Well, tax, I think he implies to reduce all of the tax, yeah? So
Yeah,
that means the prices will go down. But then there's a problem with this. The US government, with its $19 trillion debt,
But he was gonna change that because as soon as he decreases taxes and it's a very long-term plan that he has.
it's not going to happen in the next 4 years.
Yeah.
So he needs to,
It's a 10-year plan because he's trying to change the whole way that the U.S. Has been working. It has a $618 billion deficit, trade deficit. and he
well,
wants
that's
to-
the trade deficit side. Yeah, I think
He
he
wants to change that into a surplus.
looks like he's going to have a long battle to go with. It won't happen in the 10 years then, with the deficit thing, basically. Debt hanging, then you have the military bases for which you are borrowing to finance, and
Those alone, those
and
those
NATO and
things.
UN. I think there's a whole lot of finances involved in this, and I think who benefits from them is the Wall Street again. Advisors.
He made an executive order today to stop funding to several UN organizations in billions of dollars.
Well, that's a saving then. I think the US was the bank for the whole world until now because of globalization.
Even
Um,
NATO is like
NATO, obviously, NATO is without America is not a NATO anymore. That's why European governments are forming European army, because of Trump again threatening with the fund withdrawal from NATO, funds withdrawal. That means somebody needs to pay for these military presences, right? The NATO presences in Afghanistan, in Iraq, and all different parts of the world.
the US used to pay
Now, yeah, US is obviously, NATO itself is a whole US thing. Anyway, so it's all about finances. It's about funding. He's a businessman, and he knows how to reorganize organization. Hopefully, he doesn't bankrupt, because he used to bankrupt the companies to save other companies that he has in his holding.
I
So,
just hope it doesn't start World War III.
sorry?
I just hope it doesn't start World War III.
World War III is less likely, because World War III, The war
It
only will
depends on
happen
his- It
with-
depends on his actions, basically.
Yeah.
He's changing the international arena into anarchy. He's defunding the UN. The UN is one of the reasons there hasn't been a bigger war yet.
is the UN, yeah.
Yeah.
But it wasn't able to stop the Iraq war. That was interesting, because
It kept power in the US's hands, which led
basically
to
the
people-
whole UN said no war. There was voting, and the UN Security Council was against it. But I think the US government just allied with NATO parties independently.
As long
So,
as there's one country-
but then yeah, UN has a sort of symbolic presence there. UN has a symbolic presence, but not necessarily very effective these days. And that's why Donald Trump knows this. Withdrawing all the funds from there. Anyway, so we'll come to that at some point when we talk about country risks. So let's focus on this. Now, by the way, tax exempt debt, the investment in this debt is actually tax free. So the gains you have, the interest payments you receive from these bonds is taxed at the federal rate and local rates, but they are tax exempt. So these are attractive bonds. Rather than buying a CD from HSBC or commercial paper from Tesco and then having to pay capital gains tax plus interest payments tax, you could invest in these as well. And these investments are tax-free. Now, notice that industrial revenue bonds, relatively, in fact, much lower in each year of issue than general obligation bonds. So general obligation bonds are for general purposes, building infrastructure, while industrial development bonds are low. Now notice this. This is a bad indication, isn't it, of how bad industrial development is in the US. So not much is going into developing the industry, but a lot is going into building hospitals and roads. So, of course, these roads are maybe charged. Do you call these toll roads? What do you call them? Yeah, toll roads. Yeah, they will be charged, but they won't be as much as the as much profitable or beneficial as industrial development. Because with the industrial development, you will have employment. With the development of infrastructure, employment is temporary, because building the road may employ a few people, but once the road is built in 2 years, these people have to look for jobs. But with industrial development bonds, you are actually opening a factory where the people can permanently employ, right? But then by looking at this, much of the municipal bonds were actually, these general obligation bonds. So it's a bad shape of industry that in America. This could just simply indicate, that's why probably Donald Trump was fed up with all this infrastructure development, but then not much of employment in the long run, yeah? There's not much of employment in permanent employment. So usually governments are happy doing these investments because US infrastructure is aging, and even Donald Trump himself said he's investing billions on them. So that's one reason why investment banks are optimistic about Donald Trump's coming on power, although they are losing globalization when he comes in, obviously. Now, private issues, corporate bonds now. We talked about agency and local bank, local issues and government issues, now private issues. Private issues of bonds are usually rated, like obviously the others also rated, but they are default free. Now, if another government, let's say Poland, issues its own treasury bill, obviously it's rated by organizations like Moody's and S&P's, but they won't be as default free as the US ones. Now, that's about government bonds. Now, coming back to corporate bonds, they are issued but rated as well at the same time. So there are two types of them: investment grade bonds with the highest rating of AAA, lowest with this, depending on the type of rating you receive, one from Moody's and one from S&P, but they are equivalent. And you have non-investment grade bonds, they're junk bonds. Of course, you can invest in them, but they are junk bonds in the sense that there is a high risk of default by the issuers. And because of low ratings, investors generally require risk premium, high risk premium on these bonds. So interest rate you receive on these investments will be higher. So junk bonds command high interest rates. That's because of their ratings or their status as not default free. So AA rated bonds are usually default free. US government bonds are usually AA rated. British is now B something, AAB or something. But US bonds, government bonds are AA rated. And corporations receiving AAA, you could expect them to be virtually default free. It's hard to get AAA usually. But before 2008, securities were issued AA rates, mortgage-backed securities. So since 2008, it became a lot more harder to get AA rate, because they realized that they had to do a proper work on ratings. I mean the bond, Moody's and S&P. Shows me my battery is running out of charge, so I'll have to quickly stop here and then connect the charger. So, mortgage-backed securities. Now, these were the ones that were rated AAA, triple A's. Where do I? Do you see anywhere here that the? Ah. I hope it's working. Yeah. Mortgage-backed securities. These are securities with a collateral being mortgages. They are also called pass-throughs because the payments to that the holders of these securities receive are contingent on the payments of mortgages. So, you remember that I drew the long connection between borrower and the mortgage-backed security holder. That's basically borrower of mortgages makes interest payments now to the bank who originates the mortgage. Then the bank then puts together this mortgage into a security and sells it to another bank. And then another bank gets a guarantee basically from the borrower that it pays the bond interest payments on time. So as the bond, this is a virtual guarantee basically from a mortgage receiver of funds for mortgage to the security holder usually. So long as the mortgage holder pays the interest payments to the originator pays the interest payments to the security holder, and then there is a market for these mortgage-backed securities. But if the borrower of the mortgage defaults or is bankrupt, is not able to pay, then originator obviously will not receive the cash, monthly cash. Then it is not able to pay, pass it through to the next intermediary, whoever holds the securities. So that's why we call them mortgage-backed. The funds it's more like derivatives. The values of the mortgage-backed securities depend on the original security that was issued. So the whole process is securitization. Yeah, but they work more like what we call this, derivatives. So let me just quickly go back and give you a graphical explanation of this.